right. Well, I think we will go ahead and get started just so we can make the most of our time. As I already mentioned, we are recording this. You can put questions in the chat. Anna's watching those, so she'll be sure that we see whatever questions come up and we will answer those at the end. Welcome to our webinar. This is really a follow-up to Rob's article that he wrote a month ago. So like the title says, we're covering DOGE, the economy, and your investments. And really, what we wanted to cover in this presentation, because that article was a month ago, there's so much happening so quickly. And so even when Rob wrote his first article of the year, it was already, 4 weeks into a new administration. And so there's so much changing so quickly. We wanted to be sure that we're sharing any updates in our thinking and also just give you the ability to hear what we're thinking and how it affects your investments. So I know in the article we kind of talked very high level of the economy, the market, but we also wanted to say, how this affects your investments that we're managing for you as well. So this is a follow-up, so you can see that article. We will link to all of these things in the recording, so you can get that as well if you want to share that with anyone. But really, so much has changed. And please ask your questions. So if you think of anything as we go along, as Rob is talking, please just throw those in the chat and we'll answer them. All right. Well, welcome, Rob. So this is Robert Stoll. I know most of you know him, but we do have some people who probably have not met you. So thank you for joining us. Rob is our Chief Investment Officer and keeps track of everything going on. And I know this is going to be really helpful for a lot of people. So thanks for joining
Yeah.
us, Rob.
Well, thank you. Thank you. Yeah, this will be very good. I'll fully admit up front, it's things are moving very fast, and I would be lying if I said I have cemented my views on anything, but we'll kind of talk about all the puts and takes and what that might mean. So, yeah.
Okay. All right, great. Well, first, I'm just gonna kind of share the main themes that we're gonna cover, and there will be kind of underlying questions within these pieces. But very high level, kind of federal budget issues, rebalancing the economy, current economic trends, and then what this means for investment portfolios. Rob, I'll let you start here because I know this is kind of a story as we're
Yeah.
talking through all of these, and it's kind of, starting at the beginning is where we have to start.
Yeah. It's really important. I just with in this day and age, we don't dismiss the fact that the political climate is very volatile and there's lots of opinions. But we are stewards of the investments you've entrusted with us, and so what we really try to keep our eye on the ball. And so to really understand what's going on, I think we do have to start by looking at kind of the 30,000-foot view of how we got here and some of the big things that are happening, which I've written about before in the last, call it, year or so. But yeah. So we'll kind of start there just to let all of us know kind of what we're dealing with, and then we'll get into the specifics of what this administration is trying to do.
Okay.
And yeah, and we'll start here and we'll look at why the deficit is such an important issue, what this administration is doing, and then talk about tax policy a little bit. But the next slide here, what you see here is next slide.
Sorry about that.
Yep. What you see here, this I wrote about several months ago, this idea of fiscal dominance. And what I mean by that is that the deficit can get to a point where it's so large that it starts to dominate the economy. And what I mean by that is the interest cost in particular of financing all this debt becomes so large that it crowds out spending on core services. And this is a chart that I've updated from that article, and we'll link to this as well. But what you can see here is running a deficit in this country is not unusual. If you go back almost 100 years now, we've almost exclusively run deficits. But you'll also notice that where we're at right now, we're running deficits of a little bit more than 6% of GDP, gross domestic product. All that is if you kind of took the sum value of all the income created in our economy each year, that is what is called gross domestic product. So right now, the deficit is more than 6% of that. If you look back historically and look before 2009, mainly because that's kind of the old regime, you never really saw deficits more than 3.5%. Like that, a deficit of 3% is kind of what the economy will operate at without too much of an issue. But you see that in the 2008, 2009 recession, we had to spend a ton of money to get out of that. That was a huge deal. And then deficits came down close to that 3 to 4% range again. But then COVID hit, and we had not only huge deficits, but that's actually continued. Not as large as what they were in 20 and 21, but clearly the deficit we're running today is, other than wartime or financial crises in the past, we've never really operated at a deficit like this. So, I think this is really important to understand because regardless of who would have won the election in November, this would have been something to deal with. It is a big issue. There's people on both sides of the aisle that recognize this as an issue. But certainly for this administration, as we'll kind of get into DOGE here in a little bit, um, this is what they're really looking at right now.
Mhm.
So if we look at, what is this administration trying to do to deal with this? I do think it is notable. If you look at President Trump's first term, I think you could have argued that his mindset was deficits don't matter. He pushed through a big tax cut, which made the deficit go up. 2020 with the COVID, there was kind of a spare no expense response by the government to keep the economy from really falling too far. But but it is interesting, I think, that President Trump this time around has surrounded himself with a lot of people, Elon Musk being one, but also his Treasury Secretary and some others that do see the deficit as a real issue that needs immediate attention. And the way they're going about this, at least initially, is they have established this Department of Government Efficiency, which we call DOGE for short. And it is tasked, it's set up to run between now and July 4th of 2026, our country's 250th birthday. And it is really tasked to go through almost line by line, department by department, look at everything that we're spending on. They're looking for job efficiencies. So to the extent we have too many government employees, they're looking for ways to streamline that. They're looking at fraud and waste and a lot of different things. And obviously, this has been over the last 2 months, there's been a lot of emotional response to what is going on. But the point here is that the point I want to make is this, whether it's DOGE or something else, the deficit is something that needs to get dealt with. As we've met with clients over the years, time and time again, we've always heard that one of the big worries for a lot of our clients in retirement or approaching retirement is what are tax rates going to be when I'm in retirement? And the default response has always been, well, they're definitely going to be higher because the deficit is so high. So this does matter, and DOGE, I just put, they actually have a website you can go on and see what the estimated savings are and amount saved per taxpayer. I'm a little, I don't know how valid a lot of these numbers are because I think they sometimes double count or account for stuff more than once. But the trend is clear. The trend is clear. They are definitely trying to cut spending. Um, Obviously, I think the big thing is that we need to think about, and this is something we kind of saw the last couple weeks, but will become a bigger issue as we get into late summer and early fall, is the only way these savings will matter is if Congress passes a budget that actually pulls money out. So it's one thing to sit here and say, okay, we've identified $115 billion worth of savings. But unless Congress actually passes a budget to take that funding away from whether it's the Department of Education or wherever, that money will not just go away. So that really is $1 million question. They just passed a stopgap spending bill this past week, I think on Friday. And there was a lot of contention from Republicans that are like, okay, well, if we're serious about cutting spending, let's put that through right now. And President Trump and many other Republicans were like, no, we can't do that quite yet. We'll deal with that problem later. So um, that problem later is the next reconciliation bill, which will come up, I believe, in August or September is when that really gets going. And that'll be kind of the rubber meets the road moment, I think, for whether this DOGE, this efficiency effort, it really is going to have teeth or not. It is our expectation that the current tax law, the Tax Cuts and Jobs Act that expires at the end of this year, we would place very high odds that it will get extended in a very similar form. We're not sure exactly what some of the puts and takes will be. There's talk about the state and local income tax exemptions, the caps, the otherwise known as SALT caps. So if you're an Illinois resident paying a lot of property taxes, you'll remember that when this bill passed in 2017, our tax bills went up because our exorbitant property taxes were no longer fully deductible. So it's likely that that cap will go up. So that's good news for Illinois residents paying a lot of property taxes. But we do expect that to pass. But again, it's President Trump can say he wants that and it has to pass, but we really do think that there needs to be savings enacted as well.
Mhm.
So that's kind of the first big picture. And then the budget deficit being an issue that regardless of who would be in power, that is an issue. And then I want to move on to rebalancing the economy because there are certain aspects of our economy that are out of balance, and I think it's important for us to kind of see that. So if we go to the next slide here, one of the things we've seen, or two things we've seen over the last several years, is the chart on the left here. This looks at the proportion of total job growth that is being generated by government and government related industries. And what you can see is if you kind of ignore all the spikes, generally speaking, going back to the early 70s, about 20 to 30% of total job growth in this country is generated by positions in government or kind of attached to government. So like healthcare, education, things like that. What you notice with the spikes, though, is you'll see that at each of those kind of spikes, there's almost it just kind of cuts off, and there's just a white box that ends up. Each of those moments is actually a recession, uh, and that's important to kind of look at because what you notice is before each of the recessions listed here, which whether it's 1974, the early 80s, 1991, the post-tech bubble of 2001, 2002, the financial crisis, and then COVID. The one thing you always notice in all these circumstances is that the proportion of jobs going to government related entities surged ahead of that recession. And if you look at where we are now, we've had a pretty sizable increase in the proportion of jobs generated by government. And that's starting to trend down a little bit. The latest jobs report showed more private sector job growth than public sector job growth. But I've talked on and on over the last 2 years and have been very wrong talking about a coming recession and softness in the jobs market. This is another indicator that that is going on, but I think it's notable that it's just something to think about that's still on our radar as being out of balance, that you can't sustain economic growth with government jobs. The other big imbalance we see within the US economy is something that, uh, frankly, has been a little surprising hearing out of the Trump administration and Treasury Secretary Bessent and some others is is that this view of inequality, wealth inequality is becoming a big issue, A, and B is being recognized as an issue that needs to be taken on. And this is a chart that Secretary Bessent has shared and talked about recently, where if you look at total spending, 70% of our economy in the United States is driven by consumer spending. Half of that 70% is driven by spending by the top 10% income households in the United States. So mathematically, that's always the top 10% are always disproportionate share of spending in our economy. But you can see that over the last 20, 25 years, it doesn't look like a huge change. But going from, call it 35% of spending driven by the top 10% to half, that is a really big deal. And I think, in a way, a lot of the kind of political instability we've seen on both sides is really a reflection of this reality. So you look at spending being out of balance, you look at who owns the stock market, it's almost exclusively the top 10% wealth in this country own all the stocks or almost all the stocks. And there's just this sense that and a lot of economists and people in academia have talked about this, that inequality has become a big issue. And I think I've actually written about this a little bit in the past, and I put the blame at the foot of the Federal Reserve. But again, the point here is there are imbalances that A, this administration recognizes as being a problem, and B, they seem motivated to fix it. And then the other major imbalance we have is around trade. And there's obviously a lot of talk about tariffs, and uh, President Trump seems to announce tariffs at 8 a.m. and announce a deal to avoid them at 2 p.m. It's kind of, half annoying, half head spinning, um, but but we need to recognize that there are big trade imbalances in place right now. So if you look at the United States, for instance, I didn't put a chart here, but we imported over $900 billion more than we exported last year. And this trade deficit has just grown and grown and grown. And there's a lot of reasons for it. And there's, frankly, I've studied this a lot, and I don't pretend to even understand half of what people write about it. Um, but if you're looking to understand why does this administration, why are they so hung up on tariffs? Why do they keep talking about how unfair trade policies are? Whether you agree with them or not, I think this chart right here shows where that is kind of coming from. Because if you do look at the tariffs that are levied against US goods and other countries, frankly, from areas of Europe or, Asia, you look at South Korea, for example, they're a huge exporter. China, obviously, a huge deal. But even Italy, France, Germany, a lot of places in Europe are have much higher tariffs or other kind of non-tariff barriers that could be quotas, for example, than the United States currently levies. So, it's President Trump's personality kind of being brute force. His tactic right now is to just say, you know what, we're just going to jack tariffs up and see what happens. I think that does introduce a lot of risk, not only to economic activity, but potentially inflation as well. But again, what we're looking at here, aside from the budget deficit, are these imbalances of where jobs are going, of how the spending in our economy is driven by a smaller and smaller percentage of the society, and then these imbalances in trade as well. And I think this is really, if you're really going to understand and kind of think about what's going to happen with the investment environment going forward, you just, I really think you have to acknowledge these imbalances. They do exist. They're not political. It's not a Democrat issue or a Republican issue. I mean, they are issues that need to be dealt with or at least talked about a little bit more. So,
Yeah. Rob, we did get one question that someone asked just since we're right here.
yeah.
It said, you talked about the imbalance between spenders. What do you mean by this inequality, and how is the current administration trying to address this? Can you go into a little bit more detail with that?
Yeah, so I will fully, the last part of the question, what is the administration trying to do to address this? I don't have a good answer for that right now, because they haven't been explicit, but I think this is where all these imbalances kind of tie in together. So go to trade. The idea with kind of rebalancing the trade deficit is we want more manufacturing to be done here in the US. We want manufacturing output and productivity to be better here in the US. And by doing so, that will lift up the middle class. It'll get wages going. And as kind of the middle class makes more money, they'll spend more money. And that will naturally have an impact on reducing on this slide right here, that spending by income bracket. If the middle class is doing better, then that will kind of drive their share of spending higher. So that, think about that bottom 60% or 60 to 90%. I think the hope is if you do bring manufacturing back to the US, that will address some of these other imbalances, not only from a spending standpoint here and that inequality, but also more manufacturing jobs would be more jobs created in the private sector versus the government sector. So, they haven't explicitly tied policy to, like we're going after income inequality or wealth inequality. They haven't specifically tied that to A, B, and C policies, but I think if you take a step back and look at what they really are focused on around trade in particular, that is really the way they're going about addressing some of these other inequalities.
Okay.
Yep. And one more thing I think we really need to understand now that we kind of see what are the big issues out there, what are the imbalances. The obvious question is, well, how committed is the government going to be to doing anything about it? I mean, if I'm 51 now, I've heard on and on and on about deficit problems, about Social Security problems, and we hear about these things decade after decade after decade, and nothing ever gets done about it. Um, I would say the default, if you said, what is likely to happen, cynically, I'd probably say not much is going to change from DOGE and everything else. But I think we do have to acknowledge that the messaging coming out of this administration is clearly saying that they are committed to doing this. So, if you have not seen our Treasury Secretary Scott Bessent speak, I would highly recommend searching up some of his recent interviews. I think he's extremely thoughtful. He's extremely highly regarded as far as Treasury secretaries go, and he's been very clear on this idea that A, we have imbalances, B, we have to correct those imbalances, but C, correcting those imbalances is going to necessitate some, he calls it a period of detox here, or a transition period where we're going from one way of running the economy to another. And, as he points out here, the economy has been hooked, addicted on government spending, deficit spending, and there's going to be a detox period. He's said in other interviews that, there could be disruption in the stock market, and that's part of the detox process. And then President Trump has been asked about these comments, and you can see here he hasn't been extremely explicit, but in the way he talks, there could be a little disruption. You can't really watch the stock market. We've been managing the economy by quarters. A lot of other countries are managing their economy over longer time periods. So the main message that I'm seeing coming out of this administration is that they know there's a problem. They have a plan. You can agree with it or not, between DOGE and tariffs and kind of rebalancing things. They have their plan to deal with it, but to get from point A to point B is going to necessitate some sort of detox period. Anybody who's tried to lose weight or quit drinking, for like dry January or whatever it is, it's not easy. Um, and we don't know what that's going to look like for the economy, but I think I think we need to be prepared for. We've had two great years in the stock market, 23 and 24. I think we need to be prepared mentally that the economy, economic activity might slow down, unemployment might go up a little bit, and the stock market might not generate 20% returns like it has the last couple of years. So, what is going on with the economy? How do we currently see that today? And we'll just kind of touch on two of the main themes that I think are really important for people. And number one being inflation. So we'll kind of skip to that. Next slide here. And inflation, if you're a longtime client at FDS, I've been writing about this since late 2020 about inflation being a problem. We positioned for it by moving into some inflation-linked bonds early on. That kind of did well. Inflation has come down, but it has still been very sticky. So if you look at the last inflation reading for February that came out, inflation came down, but it's still 2.8% year over year. And the Fed has this, what I think is kind of an imaginary target. I don't know why they've targeted this number, but it is what it is. But their target for inflation is 2%. So at 2.8, the Fed looks at this and say, we're still not where we need to be. We need to bring inflation down even more. Um, Tariffs, well, I'll get into that in a second. That's a more complicated thing. But if you think recently, so what are some of the inflation things we've been dealing with? Eggs, that was a really huge thing in February. The egg prices are going crazy. I can't tell you how many times I went to Costco to buy eggs and there was nothing there and really frustrating. But if you look at wholesale egg prices here, this is through yesterday or the day before. Wholesale egg prices have actually come down by half. How quickly we see that in the stores, I don't know, but it's to me, this is a classic sign of what happens with inflation is if prices rise too far too quickly, there's an immediate demand response in terms of people just not buying as much. And then as supply is ramped up to kind of correct those high prices, as manufacturers try to take advantage of that, all of a sudden their supply hits in, but the demand is lower and then prices collapse. So, um, you know, that's just one piece of inflation that has looked a little bit better. On the flip side, interestingly, oil prices have come down since the election, but unleaded gas prices have not. So they haven't really they've gone up a little bit, but they've been pretty steady. And this is another piece of the administration's economic policy as they want to drive more energy production here in the US because cheaper energy costs means more manufacturing, which means more jobs and achieves all those other goals. So we haven't really seen that yet, um, but I'd say, with inflation, the jury is really out. There's one camp that looks at these tariffs and sees them as potentially being very inflationary. I'm not in that camp simply because kind of going back to what we see here with eggs, that inflation, if you look at what happened in 2021, 2022, and inflation went up, what really happened there is you had supply disruptions, but then you had the government shoveling money at people like crazy through stimulus checks. We're not seeing that this time around, and I would argue that what really drove inflation was that people were had all these stimulus checks come in, and the nature of the American consumer is if I have $2 to spend, I'm going to end up spending two and a half. So all that money got spent very quickly and drove prices up because That's just basic economics right there. Demand goes up, prices go up. This time around, even with tariffs, so say tariffs do drive up the price of dishwashers or whatever it is, incomes are not, they're still rising, but they're not going up a lot, and there's no government stimulus going out. So, so if prices go up, in my view, what will happen is demand for said goods will go down. And so that'll kind of balance the price and the demand impact there. So I personally don't see a lot of inflation coming from tariffs. If anything, I would probably put my stake in the ground, which is a very non-consensus view that a year from now we're going to be talking more about disinflation, maybe not deflation, but I actually think inflation is going to come down faster and quicker than what people currently think. Even just this morning, General Mills, the cereal maker, came out and reported earnings, and they cut their earnings estimates for next year. And they said we were expecting some growth. Now we're not expecting any. We're actually expecting sales to contract, and they're cutting prices as a result. Kraft Heinz, another big food distributor, they just announced some price cuts recently. So I think what if you look at what's kind of going on from a granular basis, this consumer spending slowdown is already starting to become apparent to a lot of companies, and they're responding by cutting prices, which is the exact opposite dynamic from what we saw 3 or 4 years ago. And then on employment, this is another one that I've talked about. This is a very busy chart. I'll kind of explain what it means in a second. But I've written in various articles and emails that there have been signs of the jobs market slowing down. So there's indicators from the Kansas City Federal Reserve that kind of compile a lot of different indicators and to judge the health of the jobs market, and that has been trending down for over a year. Unemployment claims have gone up, not a lot, but they have ticked up a little bit. And jobs growth, monthly jobs growth has softened a lot over the last 12 months. And then if we go back to, kind of the nature of the job growth that we have gotten. So a couple slides ago, we looked at job growth driven by government, and it's like 85% of all jobs recently over the last, call it 6 to 12 months, have been generated from government. The flip side of that is that the private market, kind of the Fortune 500, small businesses, jobs growth in the private economy has actually been very, very weak. And I think that's what has kind of distorted the recession call and some of the indicators showing a soft jobs market. Yes, the jobs market has been soft in the private economy, but government spending and government employment has largely offset that thus far. But I think one thing we need to think about now with the new administration is, clearly they're going through all these departments through the government and they're starting to lay people off and, fair and unfair in many cases. But it is happening and you are seeing jobs being cut in the government. And this is a survey. This chart here is a survey. Every month, the University of Michigan does a survey of consumer confidence, and they ask a lot of different questions. But one of the questions they ask is basically, do you feel better or worse about your job prospects a year from now? And when this chart is going down, that means people feel worse about their employment outlook a year, looking out a year. And then vice versa, when it's going up, people feel a lot better. And you can see that just the other day, this index came out, and there was a very meaningful decline in consumer confidence around their job prospects. So this is something, this index moves around a lot, and it's been proven many times over. You don't trade around consumer sentiment indices because they do tend to be very volatile. But it is notable that, if you start thinking about, well, what is going to happen with the economy? If consumers aren't feeling good about their job prospects, they're not going to go out and spend on that extra vacation or, a new deck or whatever it may be. So this is where I think we need to really be mindful that as we kind of think about that transition process from here's the way the economy has run, here's the way the administration would like it to run going forward, that kind of transition period, detox period in between, it is almost certainly going to result in some sort of slowdown. Now, how bad will it be? I personally don't think we're talking about like a 2008 or even a 2002 scenario where the economy got hit really hard. But could it look like the early 90s when there was a short recession right at the end of Bush one, his term that cost him the 1992 election? Could it look something like that where unemployment goes up a couple points, things slow down, but then, it kind of fixes itself and you're fine after that? That would kind of be my base case right now. So call it maybe a mild downturn, but it's something we're obviously watching very closely. So, okay, so all that, what does this actually mean for investments? And I apologize that to kind of go on this 30-minute rant about all this, but if we're going to talk about what is the investment implications or what is the investment strategy going forward, it is really important to understand all these things. So we'll just kind of start on the next page looking at well, what is happening so far? It's kind of funny being in the seat that we occupy, and we have a lot of different clients with a lot of different backgrounds and different ages and things like that. And there's been, I would say not a huge number, but a higher number of inbound questions about, oh my goodness, what's going on with the markets? And um, what do we need to do about this? And I'm seeing all these scary headlines and things like that. And if you actually pull back and look at portfolios, so, when we're investing, we're looking at big diversified portfolios, not only investing here in the US, but internationally. So if you look at year-to-date returns through Monday, what you see is actually most markets, particularly international markets, are doing really well this year. So you look at Europe, I mean, that's a huge market. That's call it 65% of the developed market international stock index. And European stocks are up close to 15, 16% this year. China, which dominates emerging market indices, that's up about 25% this year. But, you kind of look at the left side of that chart, you see Japan, you see emerging markets, developed, Latin America. A lot of these areas are doing quite well right now, and we'll kind of get into some thoughts and reasons for that. Um, but then if you look on the right-hand side, you'll see the U.S. indices. So the kind of the S&P 500 is down about 3.5% this year. Mid cap and small cap stocks haven't done well at all this year. As our clients know, we tend to focus on the S&P 500 on an equal weight basis. That's actually flat this year after underperforming last year. But, um, relative to the sentiment and some of the feelings we see, whether it's in the media or from own clients that are asking us these questions, you would think it's a lot worse, but it really isn't. So, not that we dismiss the volatility, just to be clear.
Right.
So, looking forward, this is one thing I really want to touch upon because this is when you have an investment theme that has worked for a long, long time, that it's very easy for the market consensus to almost shift too far to one side of the boat and just become convinced that because it's been this way for a long time, it'll be this way forever. And I think one of the biggest dynamics we've seen over the last 10 to 15 years is the dominance of US stocks relative to the rest of the world. And the way you kind of see this is if you look at sort of a total stock market index for the entire world, the chart on the left will show you what proportion is made up by different geographies. So if you look at the US, for example, that if you go back, 15 years, the US stock market made up around 45, 15 45, 50% of the global stock market index. Obviously, we have the biggest economy in the world, so it'll always be the biggest percentage or should be the biggest. But you can see over the last, really since the global financial crisis of 2008, 2009, the share of global stock market value generated from the US has just gone vertical from 40 to 66%. So, that is not only people will talk about, you'll probably see this on the news a lot because this term has kind of become really popular the last couple of weeks, but they call it US exceptionalism, where we have the best companies, we have the best innovation. Those companies are driving all the value. And when you look at places like Europe or Japan or emerging markets, you just don't see that kind of economic innovation that we see here in the U.S. And I think there is a lot of truth to that. I mean, you just look at you the top companies in the US. I mean, there's a lot of companies that didn't exist 20 or 30 years ago that are now worth hundreds of billions of dollars or trillions. You look over in Europe, for example, not to pick on Europe, but I mean, they have, last I did the research, they have like maybe three or four companies that came from nowhere in the last 50 years and became prominent. So there's a lot of old industry over there and not a lot of innovation. But where I'm going with this is we kind of talk about, particularly with tariffs and rebalancing the global trade economy. I think this could be a very important catalyst for reversing some of this trend where maybe the US stock market doesn't dominate as much going forward and other parts of the world do better. And let me just kind of use two examples. Number one, Europe. So if you look at Europe, that purple line, you can see it's just kind of been a slow bleed for Europe for the last 30 years. And there's a lot of reasons for that. It's the bureaucracy of the way the European Union is set up, and they've had a lot of problems with debt and sovereign debt. And so you can see that the share of European stocks has gone down a lot over the last 20 to 30 years. But as much as Europe is angry and saying a lot of nasty things about the U.S. and President Trump, ironically enough, it is spurring the European Union to say, you know what? If we can't count on the U.S. to pay for or cover a lot of our defense spending, we have to do that ourselves. And to do that ourselves, we, meaning Germany and France and some of these other European countries, we need to ramp up our own spending on our own defense and some other sectors that, frankly, they just kind of let atrophy over a long time because the US kind of dominated defense and dominated a lot of economic growth. So they didn't have to do a lot of heavy lifting to drive their own growth. But I think now, you could say President Trump has kind of gone about this the wrong way, but he is pushing Europe to kind of take care of their own business now. And I think that could actually be hugely bullish for European equities going forward because, again, they've kind of been stuck in kind of just a slow decay for a long time. But to the extent that they are serious about, we have to kind of take care of our own house, we have to drive our own economy, our own consumer spending, our own defense. That is a radical change from what we've seen over the last 25 years and could be very, very positive for European stocks going forward. My caveat to that is if you look at European politics, I mean, it's basically like the post office. It doesn't move. They don't really come up with the right policies and they're extremely slow to implement them. So I would say, it's a little early to put a stake in the ground and say, okay, European stocks are going to dominate the US stocks for the next 10 years. I think it's a little early for that, but it is something I'm watching very closely because to me, this is a huge, huge mind shift in terms of investing globally. The other piece of this, and they're not listed here, but China. China has, they're obviously the biggest emerging market out there. Their stock market has just been a disaster for the last 10 to 12 years. It has been really bad. Their current leadership has done a lot to, kind of put down is the only way I can really describe it. A lot of the innovators and kind of the billionaires in China, they were kind of forced into hiding, to be honest. But just over the last couple months, we've seen a shift from policy in China around that. Some of these billionaires and innovators that were sidelined are now becoming a more prominent part of the government, which could be a big signal that kind of the pressure on Chinese equities is coming off. But the other amazing thing is the value added of China. Uh, they are moving from just making widgets to actually making artificial intelligence chatbots. They're making electric vehicles. They're doing a lot of like really interesting and high value added stuff that they weren't really doing before. And if you get that combined with a more lenient government towards some of these innovators, then that could be a huge positive for emerging market equities as well. And then just talking about bonds here, for any of our clients who are in retirement or close to retirement and you have 30 or 40% of your portfolio in bonds, you're looking at the last couple of years and you're like, well, bonds have really stunk. And they have. We've endured really since 2021, one of the worst periods for bond performance that we've seen in the last 100 years. And uh, so that's the bad news. The good news is, I think with where interest rates are today, they are at a much more normal level. We have to recognize that 4 years ago, we had a 10-year treasury rate that was under 1%, absolutely unprecedented. Now it's at 4.3. I think that's a much more sustainable level. So if you kind of look at where yields are today, assuming they don't move, you're basically clipping a coupon at, call it 4.5%, which is what you need bonds to do. You don't need them to be growing 10% a year. So I feel a lot better about where that is going, but a lot of that does, or a lot of bond performance does hinge on the success of these deficit reduction efforts because with interest rates where they are, interest costs in the budget have ballooned to $1.2 trillion per year. I mean, think about that. Our government spends over $1 trillion a year just to pay interest on government debt. And that has exacerbated the budget situation. So um, you know, that's why a lot of these efforts to reduce the deficit are really important as well. So kind of summarizing our thoughts on what we're thinking about right now with respect to the market. Over the last several years, obviously there's been a bonanza with artificial intelligence and a lot of stocks related to that, like Nvidia and Facebook, now known as Meta. These stocks have absolutely dominated investment returns, not just in the US, but globally for the last 24 months. But I think as we're kind of seeing these earnings reports come out, I thought Nvidia's latest earnings report was instructive because they beat numbers, estimates went up, but the stock went down. And I think that is a big tell that we're at the point in the AI cycle where investors are kind of like, okay, we know you've had to spend like drunken sailors to buy all these chips and build this stuff out, but we're at the point now where they actually have to start proving that there's a revenue model to these businesses. So are people willing to pay $20 a month or $30 a month for ChatGPT or, some of these other chat bots? That remains to be seen. So I think we're at a point now where the leadership of the stock market here in the US is going to shift away from that Mag 7 towards basically everything else that didn't do well for the last couple of years. So like energy stocks, consumer staple stocks, healthcare. Some of these areas that have lagged a lot the last couple of years are actually starting to catch up pretty quickly now. And, I wouldn't be surprised if these policies do continue to go through and this manufacturing build out happens. That's clearly going to favor some of those other stocks and small and mid cap stocks as well. We've already talked about kind of the detoxing. That doesn't necessarily mean, as we have already seen with the year-to-date returns, that doesn't mean every stock in the world is going to go down. There are a lot of parts of the market that haven't done well for a long time, and investors are always sniffing out what is the next big trend, what is the next big thesis for investing. So if the thesis is switching from Mag 7 to something else, people are really going to look at, well, what is that something else? Is it Europe? Is it China? Is it some of these other sectors of US stocks that haven't done well in recent years that have really good valuations? Um, so that's one thing I really want people to know is just because we're talking about a detox period and a potential downturn, I'm not saying the global stock market is going to go down 45%. I just don't think that's going to happen. So, there will be parts of the market that get hurt more than others, but, I think there's going to be plenty of opportunities to make money in other parts of the market. More recently, you probably have your finger on buying some European ETFs right now after my bullish assessment of that. They have already gone up a lot. I think it's probably due for a breather because, a lot of these policies that Europe is talking about, they're now getting into the sausage making of having to pass legislation to actually do this. So I think there could be a little bit of a breather, but I do see that as a potentially important new theme, investment theme going forward. Commodities, I haven't really talked about it, but very interestingly, if you look at how do commodities do in economic downturns? They almost always go down. What we've seen so far this year, though, is commodities have actually held up really well and are up like 7 or 8% so far this year. And I think that's a pretty important tell because if you are talking about industrialization in the US, in Europe, there's going to be a lot of investment that has to happen in factories and things like that. And that is very supportive to commodities, industrial metals, energy markets. Precious metals have done really well recently. So I continue to like having an allocation to commodities. We don't ever put a huge allocation into it because they do tend to move around a lot, but that is an important part of the portfolio. And then finally, as I mentioned before, I think bonds going forward will start looking a little bit better as well. So,
Mhm. Well, it's
well, that's a
great.
lot, but I think, I mean, we think it's really important for our clients to know where our mind is right now, what we're thinking about, and what are the key indicators that we're watching.
Yeah. So there was, at least one question that we got before, that people submitted kind of with their registration into the webinar. So there
Mhm.
was one, and I think this will be a good chance to just kind of summarize everything you said. I think some people are like, just tell me like, how should I feel about the market? So the question was, if you could describe in a few sentences how I should feel about the market with regard to everything happening, how would you tell me if you could say, here's how you should feel?
Sure, sure, absolutely. So what I would say is take a step back and remember that the financial goals that you're investing for, whether it's largely retirement, let's just say that. These are very long-term goals. And I criticize a lot of advisors who tell clients, oh, if the market's down, just remember the long term is up and there's going to be good years and bad years. And to me, that's really cliche and I don't think it really honors the client concerns about what's going on. But at the same time, it is important as a long-term investor to realize that you're going to have some very good years, which we had in 2022 or 2023 and 2024. Those were outstanding for the stock market, above average years. So it would not be unreasonable to believe that maybe this year returns aren't going to look as good. and maybe even in the next year. I don't know. But what I would say is just keep doing what you're doing today. Focus on that long term. I'm a big believer in history. I'm a big believer in mean reversion, that our country has been through a lot over the last 100 years. And if you look at average stock returns, they're 9 to 10%. Obviously, there's been years well above that, well below that. I continue, my faith in that kind of long-term outlook is not shaken at all. And, I would even go a step further and say that, if we had done nothing, or if we do nothing about the budget deficit, for example, to me, that would be something, if that got out of control, that would be something that would shift my views about, can we really rely on history to extrapolate what might happen in the future? If we are successful as a country in kind of getting our arms around that deficit and taking that risk off the table, then to me, that is hugely, hugely bullish for the forward outlook. So what I would say is, it's like anything. If you're trying to lose weight or, improve your health or whatever, when you start doing it, it's not going to feel good. You're not going to be really happy about waking up every day and not being able to, go get a McGriddles from McDonald's or something like that, which is one of my own things I like to do. But if you stick with it and you just kind of say, okay, well, I'm doing this for the long term, I'm doing this for the long-term benefit, it'll, just keep focusing on that, because that I think is what you really need to kind of think about.
Okay, we got a couple more questions. So one, how should we feel if we're already retired? So kind of what you just said, but now someone who's already retired, anything different we should be thinking about?
Yep. Yeah. So if you're already retired, uh, two things I will say, that we always say to clients. Number one, just because you're in retirement doesn't mean you don't have a long-term time horizon. So there are actuarial tables that say if you make it to age 60, your chances of living another 20 years are really, really high, like surprisingly high. So even if you're in retirement, don't view that as, okay, I'm at the end of the road here. I mean, there's another 15, 20 years that you might have ahead of you. And when you're investing, the reason why you're investing is you want to make sure that the savings that you have are able to keep up with inflation and give you enough purchasing power on top of that to sustain your living standards. So to do that, you invest in volatile things like stocks and bonds, but you trust that the long-term averages will kind of work themselves out, which they have done historically. So what I would say is, number one, don't forget that you probably still have a long-term time horizon ahead of you. And number two, is we work with clients in retirement. I mean, one things we commonly do is we will talk to clients about their cash needs for the year, or, next year or two, and we'll say, do you think, how much cash do you think you're going to need? And we'll kind of zero in on a number as best we can. And in a lot of cases, we will like raise cash from their investments, and we'll kind of, they call it a bucket strategy. We'll put that cash in a bucket, it's in cash, it's in a money market, something like that, because you're going to need the money this year. So why, you don't want to invest it in the stock market, have it go down a lot, and then you're having to cut back your expenses. So, one of the things we routinely do with retirees is go through that exercise, and we always will have a certain amount of cash set aside for this year's expenses or something like that, so that the retiree knows, I know the cash is there. I know I can continue to do the things I want to do this year. And depending on what the markets do, we'll reassess it a year from now, look at the cash needs, look at what the market did or is doing, and we'll kind of adjust as necessary. But um, at no point I would say, as a retired client of FDS, are we just gonna like fully invest you and hope for the best? We'd never do that. We invest you conservatively, and often work with you to have cash kind of set aside so you're not having to worry about paying the bills this year. So to
Hmm.
put
Yeah.
it bluntly.
Yeah, I think that's a good example of investing for the long term, but also being aware of what's happening in the near term. And I think that's really why like, this is an example, this webinar of wanting to make sure that concerns are heard. So, we can also understand those and say, if there's something we can do to make you feel better, that still allows your plan to work, we want to be sensitive to that. Okay, another question. If you're close to retirement in light of the instability in the market, is it wise to keep contributing to Roths, et cetera, or would that money be better served somewhere else?
Yep. Yeah. So this the answer you're not going to like to hear is it depends. So it really depends on your situation. That is something we can talk about kind of offline a little bit and in terms of what is the best strategy for this year. But what I would say is my experience, I've been in the financial sector since 1997, have seen a lot of cycles, a lot of good cycles, bad cycles. If there's one discipline I can absolutely say, or one thing I've learned is you got to just stick to your plan. And if your plan says I'm going to save X amount of dollars in my 401k, in my Roth, or my traditional IRA, wherever it is, uh, don't let the market dissuade you or persuade you from doing that. So, Warren Buffett always talks about be fearful when people are greedy and be greedy when people are fearful. And what he means by that is our tendency, and I've been guilty of this myself, is when the stock market is roaring and doing great, I want to put as much money in there as possible because obviously you want to make money. On the other side, when things don't look good, like 2008 or the early days of COVID 5 years ago, the inclination is, well, I put all this money in, I don't want to lose it, so I better take it out so I can protect it and I'll get back in later. But not only our experience, like my experience personally, our experience as advisors seeing clients, do some of this stuff, and there's tons of academic work as well that suggests if you don't stick to your plan and you start reacting to what the market is doing, you are almost certainly going to be worse off. So, to answer your question directly, if your plan was to contribute to a Roth this year, do it. I mean, don't let the market dissuade you from doing that because you're dealing with a long-term plan, you have long-term goals, and part of doing that is saving into for that goal. So absolutely continue to do that. What I would say, and this doesn't directly answer this question, but is very applicable, is for a lot of our clients who are nearing retirement or in the early years of retirement, we may have suggested or we may be doing Roth conversions where you're maybe in a zone right now where you've already retired, you don't have a lot of income, and we've been telling you, hey, let's convert some of your pre-tax retirement to a Roth so that, yes, you'll pay some tax today, but you're going to save a lot of tax in the future. If we do get a more meaningful stock market downturn, and I'm not predicting that, but if that were to happen, if stocks went down like 15-20%, we will probably be on the phone with you saying, hey, that Roth conversion we've been talking about the last couple of years, let's get on that because essentially when stocks come down, if you're converting a fixed dollar amount, let's say we're going to convert $50,000 this year. If we're doing it at the beginning of the year when your portfolio is worth 100 or call it $1 million, that's we want to convert 5% of your portfolio, that 50,000. If stock go down a lot and all of a sudden your portfolio is worth 800,000, but we still convert that 50,000, we're actually converting a much larger portion of your pre-tax retirement than we were before. And then if history kind of provides a guide, eventually things come back, stocks come back, and you come out of it with a much larger Roth than what we would have expected had stocks not gone down in the first place. So I would say if you are doing Roth conversions, if we're telling you to do Roth conversions, stocks really haven't come down a lot relative to where they've been over recent months. So I wouldn't say the impetus is there right now, but if they did come down a little bit more, that would probably be something that will be on the horn with you, saying, hey, instead of waiting until November to do this, let's just go ahead and do it now and try to take advantage of this.
Great. All right, one last question, just because we've had several questions around retirement with a
Mhm.
lot of the changes that are being talked about with the administration. What agencies, I guess, or what services are actually going to change and impact people? So an example is Social Security. Maybe just comment on that a little bit, since we're talking about decreasing spending. Naturally, people think that's decreasing something I'm receiving. So maybe
Yeah.
just touch on that a little bit, and then I can wrap us up.
Yep. Yeah, sure. So, yeah, so this is where, I think a lot of there's been a lot of talk and we always approach this just from like what are the facts, ma'am? I forget what TV show that was from, but
Mhm.
I remember that watching that as a kid. Um, if you look at, we hear a lot about, oh, there's stuff getting cut from Social Security, stuff being cut from defense, stuff potentially being cut out of the Health and Human Services, things like that. What is being talked here right now is not actual benefit cuts. So take Social Security. There's nobody, and I know a lot of people have said, Elon Musk is saying he wants to cut Social Security, and that's a big deal. Nobody is saying that. Like he's not saying that. President Trump has said a number of times, absolutely no way Social Security benefits are going to get cut. So there's no push to actually to cut actual benefits. Um, what the impetus really is around is cutting, fraud and waste. And that is a little ambiguous, and some of the numbers can seem large, and it seems like they're going to cut benefits, but I mean, that is their motivation. It's not necessarily to cut the benefits, it's to cut the fraud and waste around that. So, again, around Social Security, this is where I will push back on Elon Musk a bit. He's been on his on Twitter X, saying, oh, look at all these people age 150 years old. They're getting Social Security benefits. All this money is being wasted. I think that is completely untrue. There might be people on Social Security rolls that are not listed as being deceased, and maybe they're listed at being 150 years old, but I've actually looked at the data, and there are 62 million people, according to the census, there's 62 million people in the United States age 62 or older, or 65 million, something like that. And the number of Social Security recipients is like 61. So there's no mismatch between that. And if you would have said, look at the census and there's 65 million people that are eligible for Social Security and there's 100 million people getting a check for it, then it's like, well, yeah, obviously there's a big problem, but I don't see that at all. So the problem is not the benefit, it's more, I guess some of the efficiencies that could be around that. Other areas, I'll be perfectly honest. When I went to college, I did not want to get into finance. I wanted to get into meteorology. That's still kind of a hobby of mine, and I follow a lot of people. And you look at some of the cuts that have happened at NOAA and the National Weather Service, and those cuts have been, I would say, putting it as nicely as possible, indiscriminate and wrong in a lot of cases. So, if you think about services that might be cut that would affect us, that would be an example of something where, they cut just for the sake of cutting, but you're actually cutting in a bone a lot. So, um, I wouldn't say we're going to see benefit cuts in terms of Social Security, but there might be some things at the margin that do kind of cut the bone a little bit. Yeah.
hmm Yeah, and I think this is something, as I kind of wrap up here, this is something that, you and I talk about a lot, Rob, where whenever we're talking about investments, the economy, the market, we want to stick to the facts. We want to look at things not from one political side or the other, or even how we think or how someone else thinks, but more from the perspective of what does the data say? What do the numbers say? Historically now, what are we seeing as trends? And then applying it to, so what should we do in that case? And I think people are also feeling that you can feel two different things at once. You may agree or disagree with everything happening, while at the same time also feeling for all of those people who are being affected by it. And so that's where we just want to be sure that we're being sensitive when we're talking about these things, that we're really sticking to, here's the facts, here's what matters to us, here's what we can do about it, or here's what we're going to do about it. But also, we want to hear and we want to help those people who are being affected by it. So hopefully, as you're listening, that's something that we can for sure say that is what we're committing to do, so that when you read or when you listen to us, this is something you can share with anyone. And hopefully it helps anyone, regardless of how they think or are feeling about everything. So, we will continue to update through articles, maybe having another one of these webinars. We're kind of just watching to see how quickly things change or what changes, but that's kind of where we're kind of watching to sense, okay, do we need to say something else? Because again, so much has changed. So that's our goal, is to always kind of keep you up to date so you can feel good about how we're investing you, how your financial plan is, and so that you can enjoy life. You can go live knowing that these things are being handled for you. So thank you so much for joining us. If you have any questions, even afterwards, please, you know how to email those to us. Like I said, we're going to keep you updated. We're here for you. So, share this with anyone. We will send you the recording and any links, and these slides as well. So you'll get all of these, I would say, by the end of the week. So thank you so much for joining us. And I know we'll talk to many of you
Thank you.
soon. Thank you.